Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really happy to have with me John Rubino, who was available, thank God, at the last minute to fill in for Miss Shedlack, who was not able to be with us today. So thanks for joining me again, John.
Hey, Jay. Thanks for having me back on.
Oh, always good to talk to you. DollarCollapse.com is a place where all of my listeners should go to, read John's work and a lot of other very important things that are there. I think that is the best advice I can give you today is to go to DollarCollapse.com. John, our question for the day is, why does the Fed persist with failed policies? And, the Fed, it certainly tried in the 1930s to print money, to print our way out. The Keynesian economics were just coming into vogue then at that time. The idea that we could just stimulate the demand side of the economy, don't worry about supply. It's too much supply. We need more demand, and so government deficit spending, print money to pay for it. Don't tax people to pay for it. And they did it. They tried it in the 30s. It didn't work. They did not acknowledge it didn't work. They thought they just didn't do it well enough. And Ben Bernanke promised Milton Friedman, shortly before he passed away, that we'll not fail you this time, Milton. This time we're going to print enough money to make sure it really works. And so 2008, 2009 was the test, the big test. And here we are 8 years later, and it still isn't working again. The only answer, though, they have is to double down, John. Why does the Fed persist in failed policies? I think it was, somebody once said that, that's the mark of insanity, if you keep doing the same thing and expect different results. But why is the Fed doing it?
Yeah, well, it is the only tool they've got. Keynesian economic theory doesn't look at the amount of debt in the system, which is a crucial oversight. So in their analytical framework, if you cut interest rates and if you increase government spending, you get more people buying more stuff. In other words, higher aggregate demand. And that's their target. To them, if aggregate demand is growing, then the economy is basically fine. And what they've overlooked over the last 70 years is that lowering interest rates and increasing government spending work pretty well when debt is fairly low and interest rates are fairly high. In other words, then you have lots of leeway to play around. But because they've been doing the same thing over and over again, and debt has been growing with each new cycle and interest rates have been pushed down further and further, we're at the point now where their ideas are absurd. If you lower interest rates from here, you get negative interest rates around the world, which we already have. With about $13 trillion of government debt out there, we're trading with negative yields. And if you increase government spending from here, you get deficits and total debt that are at record levels for virtually everybody, and at levels that, when they've occurred in the past for other countries, have been debilitating. And yet these guys are proposing to do the same thing. Let's increase government spending because what we've done so far didn't work. Let's cut interest rates even further. And let's, by the way, ban cash, because it's easier to have negative interest rates if everybody is on electronic accounts where we can watch them and control their bank accounts and stuff. And so that's the absurdity that we have reached now, and it doesn't look like it's going to end. It doesn't look like anybody's going to say, oh, okay, well, this didn't work, so let's try something fundamentally different instead of just variations on the same theme. Nobody's doing that, and the reason is that, first of all, basically everybody who's in charge of anything believes that Keynesian economics are the way to go, and second of all, there's no real political benefit in doing what, for instance, the Austrian School of Economics would say is the right thing to do at this point, which is to have the crash. Get rid of this debt by going through the inevitable, unavoidable financial crisis and subsequent big recession or actual depression that you have to go through when you borrowed this much money. There is no alternative to wiping out this debt somehow. And the problem with that is that any politician who presides over that process gets booted out of office in a heartbeat by all the people who are hurt by it. So nobody wants to do it. So we're stuck in this box now.
Well, we're stuck in this box now, but there is a battle going on nonetheless within the Fed. It seems to be a very divided Fed now. There is, on the one hand, Bill Dudley from the New York Fed, I believe, that is saying and pushing, at least this is what you see publicly, he's pushing for higher rates. What he's doing behind closed doors, who knows? But So you have a division between the hawks and the doves, so-called. I guess Yellen would be on the other side, and she wants more of the Keynesian approach to lower rates and even go negative. And but I came across an article in the Futures magazine titled "The Fed Has to Raise Rates, but They Can't, but They Will." And that was the title of the article. So tell me, John, why do some people at the Fed feel they need to raise rates? If the conventional wisdom is that we need to keep lowering them so we stimulate more demand, why is there a dissension among some members of the Fed? Are some people actually seeing the reality of what this is doing, what you were talking about?
No, none of these guys are seeing any version of reality as far as I can tell. And one other thing, Jay, they should never let these Fed governors speak because they contradict each other.
Yeah.
You've got one guy saying, we need a higher inflation target of 4%, and another guy saying, well, we've met our goals, let's raise interest rates. No other organization that I know of makes decisions that way. You have your internal dialogue, and then you come to a conclusion, and then everybody goes out and is on the same page after that. These guys are just randomly making things up, it seems like. And anyhow, that's annoying. But the reason that there seems to be some debate over whether interest rates should go up or down is because the Fed has some different constituencies. It's a private organization owned by the big banks, and interest rates have gone down to the point where banks can't make as much money as they used to in this environment. There was a study just out about how the Japanese banks are making several $1 billion a year less now in a negative interest rate environment than they would be otherwise. And it's a similar thing in the U.S. The big banks that own the Fed would like rates to go up because that would widen out their loan margins. In other words, they'd be able to lend money and make more of a profit. And so they're putting pressure on the Fed to do that. Meanwhile, you've got the standard Keynesian theory saying, you know what, unless we're growing a lot faster than this, we should be cutting rates instead of raising them. And that's the debate. But if they raised rates appreciably, let's say a full point over the course of the next 6 months on the Fed funds rate, that would destabilize the financial markets in several ways, cause a crisis, and then you'd see even the guys who are talking about raising rates now reverse course in a heartbeat. They would go back to cutting rates and calling for big government deficits, et cetera, et cetera. So a little tiny uptick in rates really doesn't mean anything in the scheme of things. There's no theoretical debate going on here. There's just different groups trying to make money for themselves and looking at how to do it in the short run. But overall, the theoretical framework, the models that these guys are using have not changed. And it's the models that are flawed. So if the Fed were to raise interest rates, for instance, back to historically normal levels, which is to say maybe 6 or 7% on the long bond, 3 or 4% at short, maturities of government paper, you would see the interest costs of basically the whole world go through the roof because everybody has borrowed money on variable terms. Governments are doing most of their financing at the short end of the spectrum right now because that's where rates are lowest. So if they raised rates, then their rollover costs of their debt would go through the roof and their budgets would explode, or the central banks would have to basically cancel all that debt and in effect just wipe out the liability side of the equation and let the cash that they created over the past few years just live out there alone, which would be in effect a huge increase in the global money supply, and that would be destabilizing. So there's no way out of this without some kind of a crisis. And the reason that we are where we are is because these guys have been operating on a flawed model for not just years, but decades. And so the problems have had a lot of time to build up, and they've become gargantuan. There's no way out of this without a crisis. And our only question now is which kind of a crisis are we going to choose?
Well, we have negative rates, and there was an article that I didn't have the time to read it as thoroughly and to understand it as thoroughly as I wanted to, but the article from Zero Hedge today, It's Gone, Why Foreign Demand for U.S. Treasuries Has Disappeared. And the article talked about how a huge amount of foreign demand has disappeared, or actually has the amount of holdings of U.S. Treasuries has disappeared, has declined very dramatically. And there were, some very interesting repercussions of these anti-free market movements of zero rates, and the hedging costs have risen to an extent because they're hedging against the currency changes too. So, as I understand it, the the negative rates are causing a lot of really big problems within the global economy, and that's just one of them. And so now all of a sudden we're not getting the foreign buying of U.S. treasuries that we had before. We know we Americans have been not buying our own treasuries. We've been relying on the Japanese and the Chinese and other foreign countries that save more than they consume. And we've gotten away with living beyond our means for a long, long time because of that. But now, perhaps one of those unintended consequences of low negative interest rates is that the demand for U.S. treasuries is declining, even though the rates are positive here and they're negative in other countries. Can you understand any of what might be going on, what some of those mechanics are that may just, cause some sort of a crisis here in the treasury markets?
Well, yeah, this is a really interesting story, and we don't completely get the ramifications of it yet because they haven't really hit. It's just starting to happen, but there haven't been any, tangible consequences yet, but there could be. Basically, what's happening is, as you said, demand for U.S. treasuries has been high around the world because our interest rates are higher than those of Germany and Japan and several other places. So it makes more sense. If you're a pension fund in Japan, you buy treasuries rather than Japanese government bonds because you make 2 or 3 extra percentage points. And you're getting a sound currency, relatively sound currency in return. But lately what's been happening is the cost of hedging the currency fluctuations, because you're being paid in a foreign currency, so you have to hedge that to make sure that fluctuations in the price of currencies don't wipe out your profit if you're that hedge fund or the pension fund. And so the cost of doing that hedging has been going up to the point where U.S. Treasury bonds now have 0 to slightly negative yields, depending on which country you're talking about. In which to buy them. And so now that $13 trillion of negative yielding government debt that I mentioned before might actually be much more than that if you include treasuries bought in foreign countries, which are now yielding 0 to slightly negative. And so that just increases the amount of debt that is in the twilight zone out there, yielding negative rates, which makes no sense. There's no theoretical or logical justification for bonds that you have to pay in order to own, and yet that's becoming the dominant kind of debt out there, and that does have some obvious ramifications, one of which is a huge increase in demand for corporate debt, which we're seeing out there.
Yes.
Everybody wants to own corporate debt because it's fairly safe if you buy IBM bonds or something like that, and it has a positive yield, so everybody's buying that. And that's leading corporations to issue huge amounts of new currency. Or new debt, sorry. And so we're seeing corporations which were already leveraging themselves to the hilt in order to buy back their stock, continue to issue more debt. I'm not sure what they're doing with the money that they're getting now because stock buybacks are starting to trail off. Yeah. But because so many people want their bonds, there's such demand for U.S. corporate debt and for emerging market debt that we're seeing huge increases in debt issuance from those guys. So we're just basically leveraging up the world even further. We were already leveraged to the point where some kind of a global financial crisis was unavoidable. Now we're putting the pedal to the metal. We're borrowing even more money at almost every level of society. So this has to end badly. But we're not done with the process yet. Clearly we think we can borrow more, and we're going to try it, and we're going to see what happens. But based on the last few years, that whatever we do next is not going to work because what we did before, which was basically identical to what we're doing now, didn't work.
No, absolutely. But I guess, academia as well as the other reasons that you mentioned, they can't go back and say, oh, we were wrong, we had the wrong model. There's too much at stake in many different ways. The politicians lose their office, but also the academicians at Harvard, Princeton, and Yale, the guys that are with PhDs behind their names, would be in trouble as well. I thought it was really interesting. So, what are the central banks? What are people? It just leads to this malinvestment that we see all the time. Corporates are getting cheap money, and they go out and buy their own stock. They're not putting it into plant and equipment, research and development as much much as they are just trying to get their stock to go up so that so that the management can exercise their options and pull more cash out of the system, more money out of the system. But I thought it was really interesting that the banks, like central banks now, with zero interest rates, such as Switzerland, I think the Swiss central bank is actually buying blue chip stocks, U.S. stocks, and so forth. So now we're seeing, money that's created out of nothing, essentially going into buying assets around the world. And I saw an article today that suggested that, in fact, the Japanese central bank has essentially nationalized the Japanese stock market with a huge amount. I think it was Bloomberg said that by the end of 2017, the 55 largest companies in Japan would be, I think, primarily owned, or at least majority owned by the central bank. So we have this nationalization almost. I mean, it just seems to me like it's pure theft, John.
Yeah, Jay, of all the bad things we've talked about so far, that's, I think, the worst. Because the government nationalizing the industrial base of the country has been tried a few times, right? Has it ever worked? No, it's
Never.
Always been a catastrophe. And
Sure.
and so if the central bank buys up all the stock of a given company, they basically control that company. And we know from history that distorts the decision-making at the company. Because here's what happens when the government owns you. If you're a utility or a steel company or an oil company or whatever, the president calls you up and says, hey, there's an election coming up. We need you to hire 10,000 more people so I can say that employment has gone up under my administration. And you do that. Now you've got all these extra people. And then a congressman calls you and says, hey, if you want your appropriation, I need you to put a factory in my district. And so you do that, and you end up almost forgetting what it was you originally did to make money, because you become basically a welfare branch of the government. And you see that, and then you crash. One good example of that that's still around now is the Brazilian state-owned oil company, BNP, which is it BNP? I don't remember their ticker symbol, but anyhow, they were this world-class oil company that was totally corrupted by the Brazilian government. And now they lost something like $20 billion in the last year, and they're on the verge of ceasing to exist if they don't get a huge government bailout. And that's what happens. And that's kind of what we're creating across the developed world now, with the central banks of the world buying up all these equities. Because again, Jay, just because we've done this much so far doesn't mean we're about to stop, because what we've done so far hasn't worked. Japan's not growing. Europe is flatlining. All of these guys are facing political turmoil, which means they have to stabilize the financial system. The stock market has become too big to fail. So you can't have a bear market anymore. And so they have to continue to buy.
Yeah, in fact, I think it was James Grant that was suggesting that the Fed is now encumbered and really beholden to the stock market, essentially. Well, we're just about out of time here, John, already. Less than 4 minutes left. Bill Gross is suggesting that people should buy what central banks have not yet bought, and then he named gold and land. Any thoughts on that?
Well, yeah, after they buy up all the equities, and they have to buy something else. It could well be that they start buying real assets. And that's no crazier than them buying up 50% of the ETFs on the Japanese market, or the Swiss central bank being the biggest holder of Apple. Once we step into this kind of territory where governments can buy any private asset they want to with impunity, there's no reason to think that gold won't be on that list. It already is for China and Russia and India. They're already buying as much gold as is produced by all the gold mines in the world. So if the Western central banks decide that maybe that's a good idea and they start doing it, then all bets are off in the gold market, that's for sure, unless they impose some kind of price control confiscation scheme. These are very thin markets, and let anybody else, any other big buyer come in, and you'll see $100 silver and $5,000 gold in no time. So that's, it's a possibility. Who knows?
It's absolutely true. It is a world, John, in which people have long forgotten the work of Adam Smith and other free market advocates. Certainly don't even want to even think about. the work of the Austrians, von Mises and other great Austrian thinkers. And yet the problem that I see is that we are losing our liberty and our freedom as a result of it. And people don't make that connection. But those of us who are Austrian thinkers understand the connection between our freedom and our liberty and the freedom to free market economics. Because if you get rid of free market economics, the government can control everything about your life, and I think that's the worst part about it. It's not so much the idea of a loss of prosperity, but it's the loss of freedom. As Ron Paul has said, if we have our freedom, we can become prosperous. If you take our freedom away, then it's not going to be a very good story. Well, we're really, unfortunately, John, out of time. Any last thought here?
Yeah, well, you just made a good point, Jay. We're on the verge of losing not just prosperity, but also freedom, because if the government controls the private sector, they control you. And that's what we're headed for right now.
And that's what we're headed for, and that's why Ken Rogoff, his new book called The Curse of Cash, which Ben Bernanke praised, is suggesting we should get rid of cash and have chips implanted into our wrists so the government can follow us around and know everything we do, every nickel that we spend. It won't be a nickel, it will be a digit. So, John, on that unhappy note, thanks again for being with us. We'll look to talk to you again sometime in the near future.
Thanks, Jay.